All right, we're going to talk about problem number 33, which is about an option. So I would encourage you again to rewrite this. Whoops. Rewrite this. So I've got my June 1st, June 30th, September 1st, 0.062, 0.066, 0.061, 0.0025, 0.0018, and NA. I've got a strike price of 0.062, that's kind of important. And then I've got fair value, intrinsic value, and time value. So the first thing that we're going to do is fill out this table here before we even start. But on June 1st, they sold goods to a foreign customer at a price. So this is accounts receivable sales entry. So I'm going to receive foreign currency. So here I'm going to sell my foreign currency. Okay. So notice I received my foreign currency, so I need to turn around and sell it. So this one was a sale, so I'm going to have a sales of a foreign currency. So they acquired an option to sell 1 million pesos in 3 months at a strike price of 0.062. So that's kind of important. Very important, the strike price, and we're given this information. So let's fill out this thing first. Right now, my question is, would I rather sell, or let's get the fair market value. So the fair value is what I paid for it. Remember, unlike a forward contract, you have to actually pay money to have an option. So it's going to cost me, I think I've got a number wrong here. I'm on the wrong one. Let me pause this a second. Okay. Now I see my issue. This is 0.0025. Okay. So I have to pay $2,500 for the option. Had I waited until June 30th to purchase the option to sell them on September 1st, I would have had to pay $1,800 for it. And notice here, we'll back into actually that one there in a second. The intrinsic value is what it's worth by the difference between, I have agreed to, let me say that again. I have the option to sell it for 0.062. I do not have to take that option. So I'm going to compare that to the spot rate. Would I rather sell it for 0.062 or 0.062? I'm indifferent because it's the exact same number. So the intrinsic value is 0. So that means the time value has to be the rest of it. So the intrinsic value plus the time value equals the fair value. So it's either intrinsic or fair. All right. Now I'm going to go to this one. Would I rather sell it for 0.062 or 0.066? And again, this is where it's important that you know whether that you're selling it. Would I rather sell it for 0.062 or 0.066? I would rather sell it for 0.066. So, in other words, I'm not going to exercise my option. So my option has a 0 intrinsic value, which means that the time value is all intrinsic value. So someone must believe it's going to flip. Notice if this were purchasing foreign currency, would I rather purchase it for 0.066 or 0.062? If this were a purchase of a foreign currency, it would have intrinsic value because of the $4,000 difference between that. And this one would be a little bit strange to do because that would come out to $4,000 and you'd have a negative time value. So the fair value would be a different number in that given problem. All right, and then on the last one, would I rather sell it for 0.062 or 0.061? I would rather sell it for 0.062 than 0.061. So notice we flipped, and now we do have an intrinsic value, and that intrinsic value is 0.001, the difference, times the 1 million pesos. So my intrinsic value, I think that should be 0.001. I really hate myself. Okay, so $1,000. I know that the time value of money to sell it on September 1st has to be 0. And so now I know that my fair value is 1,000 there, because I'm going to have 0 intrinsic value on the last, or 0 time value on the last date. It all has to be intrinsic value. So I could fill this in whatever if I want, but it's just basically not applicable in this particular case. I don't need that. All right, so again, have your 2 columns here of regular and hedge, and let's go through this. So let me pause and get the other one up. All right, so again, remember I sold it, so I have accounts receivable sales for 0.0062 times a million. So I have 62,000. Again, feel free to make a T account of accounts receivable. If I was doing a forward contract, there would be no entry on the hedge side. So this one goes on the regular side, the accounts receivable sales. On the hedge side, if this were a forward contract, I have no entry. However, you actually have to pay for an option. So I did extend cash of $2,500 because they sold it to me for 0.0025 cents per peso, and I had 1 million pesos. So I had to pay somebody $2,500 for the option to say no. So the foreign currency option is always going to be an asset. You can't have a negative here. It'll always be an asset. So I debit foreign currency option and credit cash for $2,500. So I have a journal entry here, I have a journal entry there. So let's move to June 30th. And again, part A is a cash flow hedge, part B is a fair value hedge. So the first thing under the regular hedge is exactly like every other transaction, whether it be a regular transaction or a forward contract. I need my accounts receivable to move from 0.0062 to 0.0066. It needs to go up by 0.004. Again, you can make a T account of accounts receivable and make it go from 62,000 to 66,000. But at any rate, it's going up, so I need to debit accounts receivable and foreign exchange gain. So this one obviously goes on the regular side. Now I need to do my option side. So just like the forward contract, the option side under a cash flow hedge has 3 entries. I usually do this entry first, offset the gain or loss. I had a gain up here, so I'm going to have a loss on the option down here, and the other side is to AOCI. The second one is I'm going to adjust for the fair value of the option. So notice the option is going to go from 2,500 to 1,800 to 1,000. That's your first entry. Notice in the forward contract, I adjusted the fair value of the forward contract a little bit differently because I basically did not pay for it, didn't have an original entry. So my foreign currency option has to go from 2,500 down to 1,800. So this is my second entry. I need to take my option down by $700 to get it from 25 to 1,800. Okay. My third entry is going to be adjust for the time value of the money. So I need to go from 2,500 down to 1,800. Notice this number is the same. It's $700. That's just coincidental because I didn't exercise my option. So notice that I would rather sell it for 0.066, so the intrinsic value is 0. If this were flipped and this was I'm going to buy foreign currency, this would have an intrinsic value of 0, so the time value would not be the same as the change in the foreign currency option. So this column difference would be different than this column difference. But at any rate, I have the time value is going down, so I have option expense of $700, take it to AOCI. So there's your 3 journal entries. Offset the gain or loss, adjust the option to fair value, adjust for the time value. So right now I'm sitting at 1,800 and 1,800 there. All right. So now let's go to the next one. I got to clear these so they stay on my screen. Okay. So now I'm going to September 1st, and I'm going to adjust it the same way that I just did and then settle the thing. So the first thing I'm going to do is adjust my accounts receivable, which is sitting at 0.066, and make it go down to 0.061. So notice where this one increased, now it's decreasing. So I need accounts receivable to go down by 5,000, or if you're making a T account, it's going to go down by 261,000 from 66,000. So again, this one's on your regular side. Get accounts receivable down. So remember that accounts receivable is sitting right now at 61,000. That's what's in my T account. Okay, next I'm going to go through the three things of my hedge. The first one is to offset the gain or loss. I've got a loss up here, so I need a gain down there. Take it to AOCI, which basically does is wipe out the income statement effect and move it to AOCI. The second thing is I need to adjust my option. Remember, it went from 2,500 to 1,800, and now I need to make it go down to 1,000. So my option, an option is an asset, so it's sitting at 1,800. I need it to go down to 1,000. So to do that, I need to credit my option by $800, so this is my second entry, and debit AOCI. And the last one is I need to adjust for the time value of the money. The time value of the money went from 1,800 down to 0. It will always go down to 0 on the last date, so I need option expense and AOCI of 1,800. Now I need to settle my transaction. So when I settle my transaction, remember, I have accounts receivable sales, so I need to settle that first. So I get the accounts receivable off my books. My accounts receivable is on my books. Remember the T account at 61,000. So I get it off my books for 61,000, and they hand me foreign currency, which is worth 61,000 on that date. Then I take my foreign currency and pay off, sell it. I've agreed to sell it, and if you remember, I need to stop and think about, am I going to sell it first for a second? I said I've bought an option to sell it for 0.062. Okay, do I want to exercise that option? Do I want the option to expire? Well, I would rather sell it for 0.062 instead of 0.061, so I'm going to exercise my option. By the way, if these were flipped and this was 0.061 and this was 0.062, the intrinsic value would be 0 here. It would be zeros all the way across. So you can still use this same format as I'm going to talk about here, but my option will be 0. And notice cash and foreign currency would be the same number. I wouldn't need my option. So I get my cash, which I've agreed it to sell it for 0.062. So again, don't flip and get a payable and receivables flipped. But I got cash of $62,000 because that's what I agreed to sell it for. I had to give them my foreign currency. I'm sorry, I got the foreign currency. I handed them foreign currency, which was worth $61,000, and then my option should be the plug. So if I made a T account of my option, notice it is sitting at $1,000 right there. They should all balance if everything is done right. So the impact over 2 accounting periods would be to. Thought that I just deleted everything I just recorded. So my impact on 2 accounting periods is I simply go through here and add up the gains and losses. So I had a gain offsetting a loss, a gain offsetting a loss, and then I had option expense of $2,500. So right here, $1,800 in that one, and $700 in that one. Okay. And so the total cash inflows of $59,500. Again, I say that with the caveat that they didn't put a cost of goods sold in here, which would be an impact on net income. Okay, now let's go to the fair value hedge, and I'd really prefer to show you how they are similar. On the regular hedge side, when you write these down, and if you haven't written them down, I would ask you why you haven't done it. But anyway, I'm going to assume that you've written them down because it would be silly not to. Accounts receivable, and accounts receivable are exactly the same numbers because the regular side does not change. Now, then, instead of the 3 entries, I only have 1 entry, and that entry is to adjust the option to its fair market value, and everything goes through net income instead of AOCI. So I bought the option on the 1st. My option went from $2,500 down to $1,800, so I credit it for $700 and have a loss. And then notice not AOCI, loss, because this is a fair value hedge. And then my option goes from $1,800 down to $1,000, so I credit it for $800, and so I have a loss. And then I settle the thing just exactly like I settled the fair value hedge. Get my foreign currency from settling my accounts receivable, turn around and sell it for 0.062 instead of 0.061. And you can see the impact on net income. Again, they ignore cost of goods sold, but I have the gain, the loss, and then the loss on the foreign currency option. So there you go.